Have you ever seriously wondered if there's a shortcut to financial freedom? You know, like a simple, almost secret formula that tells you exactly when you can just walk away from it all and start living life completely on your own terms. Well, for a whole lot of people, there is.
It's the million-dollar question, right? And sometimes that's literally the answer. How much do you actually need in the bank to be set for life? It can feel like this huge, impossible number to figure out, a target that's always moving just when you think you're getting close.
But what if it wasn't so complicated? For years, people who are really in the know, especially in that whole financial independence, retire early, or FIRE movement, they've been using this one simple guideline to answer that exact question. It's a rule of thumb that turns a huge, kind of scary goal into simple math.
That's it, 4%. This one little number is the key that has unlocked early retirement for thousands and thousands of people. So how on earth does this one number unlock a lifetime of freedom? Okay, let's dive in.
All right, so first, let's look at this from the optimist point of view, where the math is clean, it's simple, and honestly, it's incredibly empowering.
Now, the 4% rule isn't just some number somebody pulled out of thin air. It actually comes from a really famous piece of academic research called the Trinity Study. And what made this study so powerful is that the researchers looked back at decades of real-world stock market and bond data. They basically stress-tested all these different withdrawal rates through market booms and, more importantly, market busts, and they found that 4% was the safe number. It had a super high success rate, meaning your money was very, very likely to last for at least 30 years, and in many cases, a lot longer.
And here is where it gets really practical and, frankly, kind of fun. If withdrawing 4% of your money gets you 1 year of spending, you can just flip that math around. 1 divided by 0.04 is 25. So this gives us an even simpler shortcut, the 25 times rule. You just figure out what you think you'll spend in a year, multiply it by 25, and boom, that's your target number for financial independence. It turns a percentage into a simple multiplication problem you could do on your phone.
Okay, so let's run a quick example. Imagine you've done the math, you've tracked your spending, and you figure out that $40,000 a year would cover all your bills and let you live the life you want in retirement. You know, nothing too extravagant, but totally comfortable. So you take that $40,000, you multiply it by 25, and there it is, $1 million. And this just brilliantly illustrates the power of this rule. Suddenly, an abstract dream of retiring someday becomes a concrete number. Now, $1 million is a lot of money, no doubt about it, but it's a tangible target. It's a finish line you can actually see and work toward.
But, of course, life is rarely that simple. The past doesn't always predict the future, which brings us to the skeptic's point of view. And it's a very necessary reality check.
This right here is the core argument against blindly trusting the rule. Remember, the Trinity Study was based on historical U.S. market data. So what happens if we face a long, drawn-out period of high inflation or a series of market crashes that look totally different from anything we've ever seen before?
The plan on paper always looks so smooth, doesn't it? But reality? Reality can be messy. It's not just about the average return of the market over 30 years, it's about the order in which those returns happen. And that brings us to this really important concept at the bottom of the slide, sequence of returns risk. It's a fancy term for a simple and frankly a kind of terrifying idea. When the market downturns happen matters a lot.
This quote just hits the nail on the head. If you retire and immediately get hit with a huge market crash, you are forced to sell your investments when they're at rock-bottom prices just to pay your bills. You have to sell way more shares to get the same amount of cash. This can permanently cripple your portfolio in a way that's incredibly hard to recover from, even when the market does eventually bounce back.
Just take a look at this chart. It shows two people who retire with the exact same amount of money. Retiree A gets lucky, enjoys a few good years in the market, and the portfolio actually grows even as they're withdrawing from it. But now look at retiree B. They had the bad luck to retire right before a crash. After just 5 years, their portfolio is dramatically smaller, putting their entire retirement in jeopardy. Same money, same rule, but wildly different outcomes, all because of bad timing.
So, is the rule useless? Should you just forget about it? Not at all. It just means we can't treat it like some unbreakable law of physics. The crucial point isn't whether the rule is right or wrong, but how you use it intelligently.
So how do you make this rule a reliable tool instead of a risky gamble? Well, there are a few key principles. First, and I cannot stress this enough, your money has to be invested and growing, usually in a mix of stocks and bonds. If your $1 million is just sitting in a savings account, inflation will eat it for lunch. Market growth is the engine that makes this whole thing work. Second, for extra safety, a lot of people now look at a lower withdrawal rate, maybe 3.5% or even 3%, just to build in a bigger buffer. And finally, and this is maybe the most important part, you have to be flexible. If the market has a terrible year, maybe you tighten your belt and spend a little less. Think of the rule as a starting guideline, not a suicide pact.
So after looking at the optimistic math and the skeptical reality, this whole thing really just comes back to a personal question.
So in the end, the 4% rule isn't a guarantee. It's not a magic button you press to retire. It's more like a compass. It's a really powerful tool that can transform the vague dream of someday into a concrete number you can actually plan around. It gives you a direction, a real goal to aim for. So the real question isn't whether the rule is perfect, because it's not. The real question is, what are you going to do with it? What does your first step towards your number look like?